You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, that music means it's time once again for Options Playbook Radio, the program here on the old network where we break down the sometimes impenetrable, sometimes scary world of options into a variety of offensive and defensive plays that you can use in your own portfolio. Maybe you want to play a little defense, you want to buy a little protection, maybe you want to go on offense, you want to be a little speculative, maybe you want to get a little income. We got it all covered for you on Options Playbook Radio. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If you're saying to yourself, wait a minute, hold on, pump the brakes, this is all wrong, this is not the right guy for this show, you're right. So let me toss you over to the right guy for this show, Mr. Brian Overby, the senior options analyst and kind of just the options guy over there at Ally Invest. Brian, welcome back to your own show.
Well, it's always great to come back and be on my own show. I always appreciate that. And I love when you can join me. That means that we get to answer some listener questions. They seem to just pile up week in and week out. So it's always great to be able to address them. And that always means when you're here that we can huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via questions@theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or via the Trader Network at tradeking.com.
All right, everybody. It's time to huddle up, the portion of the show where Brian and I we get to have fun. We get to answer all your questions. Once in a while, we get to turn the tables on you guys, too. I asked you guys some questions like we did this week. Our question of the week this week, we're coming back into it. I know it's hard to believe something could just ended, but we're back into it again. Yes, it's time for earnings season, so we asked you guys a popular topic on this show and just in general with you guys out there is trading options during earnings. So we thought we'd get your pulse on how you like to do that. We said, trading options during earnings, it can be challenging. Some people live for it, others live to avoid it. So do you guys hold your options positions through earnings announcements? If so, what is your approach? Or do you guys prefer to trade just before or after of the event? So kind of around the event, but not through the event itself. Or is the whole thing just too risky? So we gave you the 4 choices. We gave you, yes, you like to trade through the event and you like to go short premium. Or yes, you like to go through the event, you like to go long premium. Or no, the whole thing's too risky. Or you trade around the event itself, but not through the event. So kind of maybe right up to the falls, Brian, but not over them. I know you like to talk earnings a lot here on the show. I know skip, strike, flies are your weapon of choice when it comes to earnings. But what are your thoughts about earnings, trading options through earnings in general, and the notion of holding them through the event itself? And then more importantly, what do you think our audience is voting for?
Right. I think the audience overall is going to be lean towards the no too risky or I trade around the event. And so those are the 2 choices where I'm at, because I think you have a very astute clientele. And I think that most of the time they're trading options more as a science than as a pure speculation tool. So I'm going to say I trade around the event, because the options in the earnings, to me, make it interesting because of the premium that it brings in. But I don't trade through, I trade around. That's where I'm gonna go. That's where I think the clients, where our listeners are at.
It's interesting. I thought there would be kind of a more monolithic vote here, and it's actually kind of pretty evenly split, which is kind of interesting. You're actually right, Brian. 31% saying they trade around the event itself. So the savvy folks maybe sling in some gamma before or after, but not through the event. Then as a tie for second place, 24% saying yes, they trade it through the event and they go short premium, so they're dark side traders. And then 24% also saying no, the whole thing's just too risky. They don't want to deal with it. And then come up in the rear, but close in the rear, 21% saying they go through the trade, they go through the earnings announcement, I should say, but they do it long premium. So Brian, kind of surprisingly evenly split. That kind of surprised me. Does it surprise you?
Yes, but not. I'm going to say it this way. The way the people answered, I expected. The one that surprises me is the long premium, the fact that it's at 21%. I'm kind of surprised by that. So people are just buying premium, and that's pure speculation in my mind.
Yeah, I know a lot. We have a core of our audience that likes to lean dark side, so I thought they might be a little bit higher. But the number who are buying options through the event itself, you're right, I'm with you. A little surprising across the board. It's a question of the week. So you still got a few more days. If you haven't played yet, listeners, head on over to Add Options. Make your voice heard, just like some of our next listeners have done. We got some lengthy ones here, Brian. So put on your listening pants here. Let's start off with a question from Welch Kwong. Hope I'm pronouncing that correctly. They say, Brian, so I'm chopped liver, but it's okay. Your show. Brian, I am still fairly new to options trading, and I have a question I hope you can help me with. Firstly, love the platform and the podcast you all spend time making to educate and share options trading strategies. Well, thank you, Welch. They go on to say, my question is essentially how did you go about determining the strategy or direction? The week prior, he's talking about the show here, the week prior you were essentially bullish with a vertical spread that could be rolled into a butterfly should underlying move against you. This week, you went bearish with a butterfly that you could roll into a credit spread if the underlying moves against you. Where did you base or determine that last week trade was headed up and this week down? Also, how did you go about determining what strikes to use for the butterfly this week? Actually, that may be more of a general question. What is your strategy to determine strikes for butterflies and spreads? Thank you for your time and hope to get some feedback. Have a great weekend. And he says, P.S. if you respond on the show, please let me know which one. Well, it's this one. No, we'll let you know. But in general, Brian, it's a good question. I know you do a lot of flies, in particular skip strike flies here on the show. I know you like to use, particularly on earnings, I know you like to use kind of that earnings straddle, I believe, is kind of your barometer, and you kind of start at the extremity of that straddle and kind of go from there. But yeah, walk our friend Welch and whoever else may be curious through some of your methodology when you have more directionally minded trades, how you go about those and how you go about determining the strikes.
So to answer them in order, the first question was about determining if you're bullish or bearish. The strategy actually makes me determine if I'm bullish or bearish. When I'm looking at the trade, and we talked about doing a long call spread that we rolled into a butterfly, the only reason why I was bullish on that long call spread is because I wanted to do a long call spread. I already had my adjustment in, which was rolling into the butterfly. So ideally, I was really pretty much neutral when I entered the trade. I'm hoping that the underlying goes up. That's better for me if it happens, but I have an alternative if it goes down. So as with a lot of just option traders in general, when you're doing something like that where you already have the plan, you already have the second trade thought out, you're just doing it because on the call side, rolling into the butterfly was easier to do than on the put side. And it was that simple in that if I'm rolling into the butterfly, that means that the market had already gone down and had gone against my long call spread. And so because of that, then the butterfly works because implied volatilities have increased, and I'm going to be selling an option contract, and I need some juice from it to roll into that butterfly in that scenario. So the fact that implied volatilities increase when the market goes down is the reason why I set up the strategy that way, as opposed to starting out with a long put spread. If that all, that's. So I guess my answer in general is I didn't have an opinion on the market. I didn't pick it because of the market. I picked it because of the opportunities that options award you. And so then next week came in, I had no opinion again, but I thought it would be nice to finish up since we did a long vertical spread. Well, let's come back and look at starting with the butterfly and turning it into a short spread. So we started with the butterfly. Why did we do it on the downside with the butterfly? Well, because the puts out of the money have a different volatility than the calls out of the money. So the put butterfly was cheaper to start than the call butterfly, equidistant out of the money. So that's why I started on the put side. And that's why if I'm going to go directional a little bit, I'm basically, once again, using an option strategy to not necessarily care where the market's going, but I have my alternative and I have my plan. So I'm neutral on either of these trades. If the market goes nowhere, both of those trades work out just fine. But ideally, I would like to be bearish on the butterfly when I'm doing it to start, and I'd like to have the bullish move on the vertical spread to start. So this might be the whole show, Mark, but I'm going to keep going. I'm going to trudge forward. So then if we look at the next thing about picking strikes, okay, as far as the strikes are concerned, it really depends on the underlying that you're using. We were looking at the SPX, and in the SPX, 1 to 2% move is a big move in the SPX on a day-to-day basis. Can it move 4%? Yes, and recently it has with all the news that we've had, but that's a rare occurrence that we get that type of move. So when I pick my strikes, specifically I'm going to look at on the butterfly side, I'm going to look at going down about 10 to 20 points. I'm going to be right in that range because I want the market to be able to reach my short strike on my short put. So it's all about what a standard move would be on the underlying that I'm trading. And what's one way that we can figure that out? And we do this every earnings, any trade that we do around earnings is we just look at the expected move for the expiration that you're using. So for example, let's pull up recently, I just a few shows back, we looked at Netflix with 2 days remaining to expiration. The stock was around 418. We looked at buying the call, buying the put. Guess what? They were saying over the next 2 days, an possible move the markets was looking at was about a 10-point move. So because of that, I made my short strike on my butterfly 10 points away. So the expected move weighs heavily in all of the strategies and the strike prices that I pick, specifically in stocks, because you're just looking at what is the market expectation of the move and using that to apply to your strategy. All right, Mark, I think I got it all.
Oh, an epic question deserves an epic answer, sir, and you certainly filled it in. You think we got time for one more? You think?
Yeah.
Let's do it here. Another one. More love here for you in the playbook. This one comes from Boost Cruz D. Hope I'm pronouncing that correctly. He says he's new to options and working with a small account size. He looked to put on a trade with a strategy from the playbook. He says a Christmas tree butterfly, I think. He says with a 57, 60, 66, 2x3x1 call fly. I guess he means strikes there. And for a total debit of 130. He doesn't say what underlying he's looking to trade for. By the way, if you send in these kind of questions, the more specifics, the better. Underlying, where the stock is, prices, all that kind of stuff. Helps us help you. This person goes on to write, I've always heard that for a defined risk debit trade, the max risk is the amount paid. However, the brokerage was saying I needed around $740 in my account to be able to put on the trade. Is there an explanation? Is the capital required to put on a trade greater than the possible max loss on defined risk debit spreads? Thank you. Well, this is actually an interesting question. It kind of gets into some of the voodoo aspect of the options world, which is what goes into the calculations for margin and that buying power number in your account. It's going to kind of vary from broker to broker. There's a lot of different things that go into those magic formulas, including, Brian, kind of a little bit of a difference of viewpoint on some strategies between what, you and I and the brokers might typically view as a strategy like a butterfly, which has many different flavors, and what the regulators like FINRA think of these types of strategies. So maybe why don't you walk us through kind of how this stuff works and maybe how the regulatory side may come into play on these kind of things.
All right, so let's start by saying, yes, this is a defined risk trade. And the Christmas tree butterfly is outlined inside the options playbook, so you can always check on it. But the biggest thing to look at is the wings are going to add up to the middle. So as the question asks, it says, I'm doing a 2 by 3 by 1. So the 2 by 3, the first spread that we're looking to buy is 3 points wide. And then the second spread, the 3 by 1 on the upside, well, that's 6 points wide. And those numbers have to total, right? So you're doing 2 debit spreads that are 3 points wide, and you're doing 1 credit spread that's 6 points wide, and that makes it defined risk right there. So the net debit that it was paid that was mentioned in here, and we don't know the underlying, is $1.30. So yes, that would be the maximum risk that you can lose. Now, to follow up on what Mark was saying is that sometimes FINRA, it's all about the interpretation of their rule. They have gone out and said, if you read the actual text, it said that a butterfly is just a butterfly, and they don't consider this a butterfly spread. So an only time that you can get margin relief is when you do an actual 1 by 2 by 1 straightforward butterfly for a net debit into the account, and that's when you get margin relief, and that's a butterfly. If not, this just happens to be a credit spread and a debit spread. So we're going to charge you the risk parameter for the credit spread, which would be 6 points, and we're going to charge you whatever the debit spread costs, which in this one, I guess they're saying it's $1.40 because it's $740. So this brokerage firm that you're working with is basically looking at this as 2 completely separate trades, and that's really the way that it's outlined by FINRA. And these things are changing, though. They're coming back to FINRA is coming back to the point where they're saying they can be defined risk, but the rules change month in and month out. And from that point going forward, I'm not an expert in it. In that, if the rules change tomorrow, then this is old data, and everything that we talked about that doesn't make sense. That's the thing about government.
Yeah, that's why I'm glad to have a guy from a brokerage firm kind of giving that perspective on this show, because this is the kind of stuff where you guys can kind of weigh in uniquely from that perspective. And you're right, it is changing on a rapid basis. Our friends over at the OIC, the Option Industry Conference, or Council, I should say, have done a great job of lobbying and trying to get some more, I think, favorable relief when it comes to the capital requirements for these types of trades and making sure offsetting positions are taken into account, and maybe different versions of the same kind of trade can also be wrapped under that. So you're right, it is trading. Hopefully we'll get to that point where margin and margin requirements will follow some sort of very rational, clear-headed rules. Not quite there yet, Boost Cruise, but hopefully we're getting there soon. So there you go. That's why your debit may have been a little bit more than you anticipated. All right, Brian, unfortunately, that's all the time we have. Got some epic questions this week on the show. Keep them coming. You guys know how to hit us up. Before we go, Brian, if people do want to hit you, maybe they want to reach out to you directly. They don't even want to bother with hitting me up and all the craziness. They want to reach out to you directly or learn more about the playbook. Where should they go? What should they do?
Well, it'd be great. They can email me directly at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. And as always, thanks for listening. Please keep sending in your listener questions. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.